My name is Kamal Warren, and I day trade the FTSE 100. Right, so here we have a example of a 5 minutes chart. So you can see, let me just try and make this a bit bigger. Right, so that's better. And you can see the formation here, what I would call as a double bottom. And generally the principles behind this chart pattern is when it confirms, i.e. the confirmation is this whole bit is really the chart pattern, and this is the beginning of the pattern here, the left side, the left cheek of the bottom if you like, and the right, and the top bit is where you're looking for the break point. So if you draw a confirmation line there, you would look to enter long as soon as the chart breaks above the pattern, which is really this 11:30 mark. So you would look to open your trade at the 11:35 opening candle, which is what I've done going by my previous block spot. But the tricky bit is where do you place the stop? So this comes back to what I mentioned earlier. So if you follow a 20-point stop method, you've got, assuming you open there, including the spread, you've got 10, 20. That takes you right around about the support line for really for the day. So so you would have your stop around about there. And the next bit, the next crucial bit is where do you place your target level, and that's where your Fibonacci comes in, Fibonacci tool, because you really don't know how far up it's going to go. It could by all means hit the resistance point from opening for the day here, and it could turn back, and it could turn and hit, get stopped out, or alternatively it can just punch through and just move straight up, like what it did for this particular day. So to see your target level is where you would derive your projected profit level using multiple chart time frame. In this case, I think I've used the 15 minutes chart. Let me just open up 15 minutes chart for the 19th. There you go. So if you take your Fibonacci tool from there to there, and you can see that is the 19th where we're looking at. So if you look at the 15 minutes chart frame, you can see how beautifully you've got an indicator here the day before, which provided you with a resistance, which is a support point for the 15th of March. And also, funnily enough, or interestingly enough, that is a 62% Fibonacci. So that indicates there's massive resistance there, and it's going to take the index quite a bit for it to punch through there. So if you move back to your 5 minutes chart, you would place your profit taking at about this level, 62.72, 64.72, which is 64.72. Can you see how the market's turned? So that's why I say, well, let's call it 64.70 even. So you have got, assuming you open there, just to keep the numbers simple, 50, 70, so that's 20 pips profits, all just using simple support, resistance, and Fibonacci. You know, interestingly enough, it just followed exactly all the chart pattern principles. It moved up, hit, even if you ignore for a second, if you were to ignore the Fibonacci numbers, if you just using your naked eye just to look at the bottoms and the highs there, you can quite clearly see there is a resistance line there derived from the support there. But if you plug in the Fibonacci as well, it becomes a formidable resistance, and true enough, it turned there. But the story doesn't end there. What happens after that? This is a typical characteristics of a it gives an indication that it's about to turn, because effectively what's happening is it tries to punch through it, it doesn't, some selling action goes through, there is some resistance that it tries to punch through again, it doesn't. And one of the things that I look at to see whether it's weakening at this point or not, if you look at the momentum indicator there, you can see the momentum is sort of declining. And this formation is known as a double top. As you can see, one top, two top, and the break point, it's in the inverted double bottom. Really, you're looking at a break point below this level there, and when it breaks Can you see what happens? It just drops all the way down. Again, similarly, like earlier, when it breaks, you can short there. So that means that is a confirmation candle. You're looking to open your trade there, your short trade there. You would need a target level as to where you're going to take your profit. Going back to Mr. Fibonacci earlier, it hit there. It's going to reverse down. The next port of call is the 50% mark, which is the 448. 448 around about there. Even if you make it 450, you'd still have about easily about 10 pips. So for that day, if you follow the two trade principle, your first trade, let's call the first trade as trade A. Your trade A would have two trades in it, trade number 1 and number 2. Number 1 would have hit your profit, and your second trade in trade A would have gone into break even at that point, and it would have been closed out around about there at break even. But your second trade would have opened there, again would have hit there, and your first trade of your trade B would have yielded a profit. The second trade of trade B would have been stopped out break even there. But alternatively, if it continues sliding down at close of market, you're looking at well, not great, but still, where did it close at? 430. So you would have opened at about 460, another 30 pips profit there. So that's basically the principles of using chart patterns.